Welcome everyone. Previously we have discussed about the components of IFRS, and let us discuss in detail each of these components and what are the contents of those components. And there are four components in IFRS, and within that first one is IFRS itself. So IFRS means International Financial Reporting Standard, and here there is a link for further analysis of each of this area. www.iasplus.com is a site where the standards issued by the IFRS is updated daily. So just go through the site, so you will get the detailed idea and information about various standards issued under IFRS until now. So we all know the concept of IFRS and the globalization of economies and opening up of major capital markets and the present extremely dynamic business environment all leads to the situation where world countries around the globe are in required for a need for a globally accepted accounting standards that requires high quality, transparent and comparable information in financial statements and reports. So the requirement of globally comparable financial reports, which are considered to be the guideline, or we can say Bible, for investors who make investments, necessitated the need for a common global language for business affairs. We have discussed about the need for why there is a need for a unified accounting standard. We have discussed about that point briefly. Not only briefly, we have discussed about that concept in the previous sessions. So we are not going further into that. Anyway, we know why there is a need. So the need for a common global language for business affairs to make the accounts of the companies more transparent and comparable. And we can say without doubt that International Financial Reporting Standards, otherwise known as IFRS, is a result of such a requirement. That is how the IFRS concept was introduced. Anyway, let us go to the real meaning of IFRS. In simple terms, International Financial Reporting Standards, otherwise known as IFRS, are a set of accounting standards developed by an independent private sector not-for-profit organization called the International Financial Reporting Standards Board to provide high quality, transparent and comparable information in financial statements. That is the real meaning of IFRS. The goal of IFRS is to provide a global framework for companies to prepare and disclose their financial statements. IFRS provides general guidelines for the preparation of financial statements rather than setting any accounting rules. So there is a universally accepted definition for IFRS. Let us go into that. So we can say IFRS may be defined as a globally recognized set of standards for the preparation and reporting of financial statements by the business entities and to prescribe the items that should be recognized as assets, liabilities, incomes and expenses. Not only that, the methods of measurement of those items, the mode of presentation of them in a set of financial statements and the related disclosure about those items. So that is the main purpose of IFRS. The main components of financial statements is assets, liabilities, incomes and expenses. So how these items are classified, what are the items that comes under these four heads, how these has to be treated, what is the rule for debit and credit for each item. We all know what is the debit and credit rule for asset as well as liability. It is not same, there is difference. So IFRS clearly point out what are the items that has to be considered as assets, What are the items that has to be considered as liabilities? Likewise for expenses and incomes. And for each item there is a rule. Whenever there is an increase in income, there is a certain rule. Whenever there is a decrease in expense, there is a certain rule. Whenever there is an increase or change in assets or liabilities, particularly in assets and liability, there are certain rules whenever there is an increase or a decrease. And how it is to be presented, where it is to be presented. We can say we know where to present or show assets and liabilities. It is not shown in the trading profit and loss, it's shown in the balance sheet. That means there is a certain set of rules and standards that has to be followed, or procedures that has to be followed while preparing financial statement, and all these are prescribed in detail in IFRS, or we can say International Financial Reporting Standards. So that is the purpose of IFRS. So let us go to next area. What are the features of IFRS? The following points which we are going to discuss is all aware by everyone. So anyway, let us go through it. First one, fair presentation and compliance with IFRS. Fair presentation of financial statement requires faithful and true representation of the effects of the transaction. Not only transactions, other events and conditions in accordance with the definitions and recognition criteria for assets, liabilities, incomes and expenses set out in the framework of IFRS. We have mentioned that part. How income is treated, how expense has to be treated, how the change in assets and liabilities has to be shown. All these are specified in IFRS. Why all these rules are specified in IFRS? In order to present the financial statement truly and fairly. Next is going concern. We all know there is an assumption that every system follow a going concern concept. The main purpose of going concern means financial statements are presented on a going concern basis unless management either intends to liquidate the entity or to cease the trade. We all know the meaning of going concern. Every business is started with the ultimate objective to conduct their activity for an indefinite period of time. If they are planning to end the business by the end of the 5 years or 10 years, if there is anything special information related to that business, it will be done like that. Otherwise, every business is started to run for an indefinite period of time. That is the main concept of going concern, and IFRS is also based on that concept. Accrual basis of accounting. A business shall recognize its items such as assets, liabilities, incomes, expenses, and in some cases we will use another term also, equity. Actually, equity means shareholders funds, and it comes under the head capital, which is shown as an item under liability. Anyway, in a business, equity is of great importance, so it will be specified separately apart from liabilities. Actually, it is an item that comes under the liability head. So whenever the contents of a financial statements are asked to mention, it will be mentioned like assets, liabilities, expenses, incomes and equity. Equity is of great importance from a corporate point of view. That is why it is mentioned separately. So as far as a business or a firm or a entity, business entity is concerned, it has to recognize its items such as assets, liabilities, equity, income and expenses when they satisfy the definition of recognition criteria for those elements in the framework of IFRS. As per the IFRS, there is certain rules and regulations regarding each of these items. It has to be complied according to the IFRS. Next one, materiality and aggregation. Every material class of similar items has to be presented separately. Items that are of dissimilar nature or function shall be presented separately unless they are immaterial. In simple terms, we can say all transactions that are of financial in nature are taken into consideration and recorded. In that sense, we can mention as materiality or aggregation concept. Next one, offsetting. Offsetting means setting aside the certain items. That is known as offsetting. Actually, offsetting is not entertained in IFRS because it is generally forbidden in IFRS. However, there are certain standards that require offsetting, and whenever those special situations come, those offsetting will be considered. Without those situations, usually IFRS doesn't entertain offsetting. Offsetting means ignoring something or setting aside certain items. That is known as per the accounting concept. We have learned that any transaction that are of financial in nature has to be considered and recorded, but there are certain items that has to be set aside. That is known as offsetting, and IFRS consider only such offsetting for special standards. In all other cases, it is forbidden. You will learn about further concept regarding offsetting in your higher studies. Next one, frequency of reporting. We all know what is meant by reporting. Reporting means communicating the position of the business from the financial point of view, or the information from the financial statements are communicated to the various users. That is known as reporting. IFRS requires that at least annually a complete set of financial statement is presented. We all follow like that because by the end of a financial year we prepare financial statements and the reports are also prepared. But in some situation, that is in case of a listed companies. Listed companies means companies that are listed in a stock exchange. That is known as listed companies. Those companies has to publish interim financial statement reports. Interim financial statement means we have mentioned that every report is to be prepared annually, and accounting period is a period of 12 months, that is 1 year. So in a business there will be two reports, that is report at the beginning and report at the end. Report at the beginning means the closing report of the previous year. In that sense only I mentioned that there are two reports. So in between two reports, that is in between two annual reports, for a listed company they have to prepare interim reports. Interim report means reports in between a period of 1 year. For example, if I own a company, my company is listed in the stock exchange. So apart from preparing an annual report, I might have to prepare a quarterly report or a semi-quarterly report or half-yearly report. You might have gone through the term quarterly reports. In the newspapers you might see quarterly report of Tata company or quarterly report of Airtel company, like that. That the concept is, if the company is listed in a stock exchange, they have to prepare interim reports. So IFRS specifically mentioned about preparation of reports regarding their financial activities. That is in meaning of frequency of reporting. Comparative information, that is the main requirement for the implementation of IFRS. We need to compare financial statement. IFRS requires entities, or we can say companies. Entity means any business unit or a company is known as entity. IFRS requires entities to present comparative information in respect of the preceding period for all amounts reported in the financial statements of the current period. In addition, the comparative information shall also be provided for narrative and descriptive information if it is relevant to understanding the financial statement of the current period. Comparative information, we have mentioned about this concept in the previous sessions. Comparative information means you need to compare the details, either the financial statement of a same company for the past 5 years or 10 years, like that, or we may compare the financial statement of one company with another. So comparative information means the companies must prepare the financial statement in such a way that it should follow the rules and regulations and standards set aside by the IFRS, and accordingly they will get comparative information. That is information that is presented in a unified form, so it is helpful in comparison. That is the meaning. And next one, consistency of presentation. Consistency means maintaining a similar pattern. That is known as consistency. IFRS requires that presentation and classification of items in financial statements are retained from one period to the next. Simple meaning, if I own a company, I am going as per the IFRS rules and standards. If I present the financial statements of my business, I have to maintain a uniform set of procedure. Usually I will follow a uniform. Usually I follow the steps that are mentioned in the standard set aside by the IFRS. anyway, but I should maintain a consistency in the methods I follow. For the 5 years I am following a one method of percentage. For example, there are different methods for computing depreciation. If I using a fixed installment method for 5 years, I should maintain that. I should not change the method for each year, so it will be difficult for comparison. And IFRS mentioned that if I am following a one system of computation, it should be maintained in each of the statements or each of the period. That is the concept. So these are the major features with regard to IFRS. Next we are going to the objectives with regard to IFRS. So you may come across a question where you are asked to present the need of IFRS or importance of IFRS or advantages, or it may ask what are the merits of IFRS, or it simply asks what are the objectives of IFRS. So when you come across any of these terms, write down the following points which we are going to discuss. First one, transparency. We have discussed about this one previously, and we have used this term in numerous situations. IFRS standards brings transparency by enhancing international comparability and quality of presenting the financial information, so that it enables the investors and other market participants to make informed economic decisions. That is the main importance of IFRS, because it maintains a uniformity. When uniformity is there, it helps in comparison, and when they follow a similar pattern of presentation, it will be helpful for the investors and other users to understand the statement. So ultimately IFRS ensures transparency in financial statements. Next one, accountability. Accountability in a sense means IFRS standards strengthen accountability by reducing the information gap between the providers of capital and the people to whom they have entrusted their money. Because investors are very much interested in knowing the position of the business in which they have invested their money. IFRS ensures that the company is working correctly as per the standards, and they are presenting the information as per the requirement of the investors, so that investors will get a clear idea about what is the position of the business. Are their money safe, or do they have to stop their investment, like that. So IFRS ensures the accountability with regard to the requirement of the investors. Next one, efficiency. Efficiency in the sense that IFRS standards contribute to economic efficiency by helping the investors to identify what are the opportunities and risk across the world economy. When various opportunities can be easily provided to the investors, they can easily invest. And if the IFRS is providing information regarding various situations that involves risk, then the investors can take decisions accordingly, thus improving the capital allocation of investors in the business field. Because of this IFRS, the investors are getting an idea about what are the areas in which there are more profitable opportunities, or what are the areas in which there will be more risk factors. So when the investors are getting information regarding the opportunities and risk relating to various business situations, they can take the decision accordingly, rather than investing their hard-earned money without knowing the situations. And IFRS ensures that the investors are getting correct information regarding opportunities and risk, because when the investors are aware about the opportunities and risk, they can take the decision accordingly. That helps in proper capital allocation. So for businesses, the use of a single trusted accounting language, we can say standard, lowers the cost of capital and reduces international reporting costs. We have mentioned about those points. That is the main purpose of implementing IFRS. When there is a unified set of standards that is followed all around the world, then everyone will have an idea about the financial statement that is prepared. If I live in India if everyone in the world follows an IFRS system, I know that if the business followed in, or the business practice followed in America is what type. I know that because they are also following IFRS. Those they are following as per the rules and regulations set by the IFRS, and I also know the rules and regulations of IFRS. So I know what is the business practice followed in America, or how their financial statements are prepared. I can easily identify the informations of the financial statement provided by the company in America. So that is the main purpose of implementing IFRS. Next one, quality information. Information is the very important factor that is required by an investor in taking decision, because they need information about the area in which they are going to invest. We will not invest in an unknown area. We will invest only we have correct information regarding whether we are going to get profit or whether we are going to suffer loss. Only on the basis of such information we are going to take decision. So with regarding quality information, the IFRS helps to provide high quality and transparent and comparable information in financial statements and other financial reporting to help participants in the world's capital market and other users to make economic decisions. We have discussed about that. IFRS helps in ensuring providing quality information to the investors, not only investors, all those interested users. We can use the term users, because users include all the parties who want to know the information of the financial statement, and IFRS ensures in providing quality information irrespective of the nature of the business or the country of the origin. Next one, standardized training. A single set of accounting standard would enable internationally to standardize training and assure better quality on global screen. It would also permit international capital to flow more freely in enabling companies to develop consistent global practices on accounting problems. Through unified set of standards, the IFRS ensures standardized training. Standardized training in the sense means every concerns or firms will follow a certain unified pattern of presentation. When there is a unified pattern of presentation, the information provided from that statements also helps the investors in taking decisions. And IFRS specifically give importance to standardized training for the implementation and application of standards in various financial statements. Next one, beneficial to the regulators. IFRS would be beneficial to regulators as the complexity and confusion associated with accounting and reporting are reduced to the minimum, because IFRS ensures that whatever the nature of the business or whatever the country of the origin of that business, everyone should follow a unified set of standards, because it will help in reducing confusion regarding which method has to be followed or what is the nature of that statement. There is no such issue, because the statements prepared by the companies working all around the world will be follow a unified pattern if they are complied to the, or if they are following the IFRS standards. So IFRS is helping providing assistance to the regulators with regard to the field of accounting. Next one, convergence in accounting standards. Convergence means simple sense, it means adoption. IFRS brings about convergence of national accounting standards of each country and international accounting standards and IFRS. Because in order to achieve the objective of a unified globally accepted standard, there should be convergence, and IFRS helps in convergence of accounting standards, not only the standards of various countries but also bringing together the international accounting standards and IFRS along with the various standards of the country. Next one, globalization of trade and capital market. We all know what is the meaning of globalization. Globalization of trade and capital. Capital market means it is a place where the shares of the companies are traded. Buying and selling of shares happens in capital market. You learn about the detailed aspects about capital market in the coming semesters. Anyway, the International Accounting Standards Board, or we can say International Financial Reporting Standards Board, that is the one that issues international standards. The board attempts to develop increased investors' interest in foreign investment. It also helps in fast and simplified process of moving funds between countries. Because of these unified standards, everyone will have proper information about various financial statements prepared by the companies. Not only the companies, but also know the financial situation of various economies. When there is sufficient information about, that is transparent and clear information about the situations all over the world in front of an investor, definitely investors will spend their money. So it helps in capital mobilization or capital allocation, and it ultimately leads to globalization of trade. Not only trade, but also in the development of capital market. So these are the major objectives of the IFRS. There are many beneficial aspects with regard to IFRS. These are some of the main points with regard to that. I try to identify more and more points with regard to the objectives or needs and importance and advantages of IFRS. Try to identify more features of IFRS. Not only, don't rely only on these 8 points alone. Try to identify more points, and with regard to objectives also try to identify more points. At least you should have details regarding 15 points, because if such a question regarding me, so what are the objectives of IFRS or what are the features of IFRS is asked as an essay question, you have to note down at least 15 points. So try to identify other additional points regarding the same topic. So go through these aspects. We will discuss about further theoretical aspects regarding the same area in the coming sessions. If you have any queries, please do let me know.